So welcome to the 8:45 section on Wednesday, April 8th. Today we're going to talk mostly about the target valuation homework assignment. But as we get started, I wanted to mention a few logistical items. First, I'm going to share my screen so it'll be easier to see on Elms. So if we go to the announcements, one of the things that I got a question about was the BMC course code. So again, the context is that the University of Maryland has a lot of licenses. We're actually the most in the world for Bloomberg terminals, lab. And Chuck LaHaye, big shout out to him, convinced Bloomberg to implement their disaster recovery mode for us. So what that means is that all of the licenses that you previously had to be on campus to access the terminals are now web licenses, and you can actually remotely dial in and use the Bloomberg terminals. That's the good news. So if anybody here wants to try out a terminal, now you're sharing it with the rest of the school, and we can't have more than 50 simultaneous users, because when the user number 51 tries to log in, it kind of kicks off one of the 50 that are on there, so it can't be on forever. But nonetheless, you're welcome to actually play with and use an actual Bloomberg terminal. Now, Bloomberg has something called BMC, Bloomberg Market Concepts, which is their training and certification. You can either take it through the terminal by typing BMC once you have a login, or you can actually take it on the web. And so that you can actually literally take the certification, learn about Bloomberg without ever being on a terminal. Normally it costs $149, but because of our license with Bloomberg, if you register with a umd.edu email address, they don't charge you anything for the certification. And what I found out from the last class is it needs a class code. So if you type in that class code and type in your email address, then it'll register you for free certification. So if you just kind of want to get a taste of the terminal, what's in it, you can try out the certification. If you want to create a login, and apparently what they said from the last class experience is that if you don't have a login, you create one, Bloomberg may verify that you're an actual UMD student. But other than that, if you do a UMD email address, it should be easy. And then you'll get a login to the terminal and you can play around with Bloomberg. So I just want to make sure you guys knew that, because that's not something that's been previously available for the online MBA. And it's only because of the unique nature of what's going on that Bloomberg is even allowing this. And so if there's a window to take advantage of this, wanted to make sure you guys knew that that was available to you. So I'll pause there. Does that make sense? Questions about any of that? Okay. The second thing I wanted to mention is at the end of the assignments for week 5, there was a midterm exam. It's right here. And also, if you went to home and you clicked on week 5, then it also mentioned the midterm exam. Now, there was going to actually be a 2-part midterm. It was midterm part 1 and midterm part 2. But I actually decided recently to just condense it all into one midterm exam. So instead of having 2 midterms, there's just 1 midterm. It used to be 2 of 5 points each. Now it's 1 of 10 points. Okay? And the exams were going to be a conversion, and then it was going to be 5 essay questions. So when I converge the exam, it's just a conversion with no essay questions. Right? So you can either take it through the assignments or click on the link here, and there's a link to the midterm exam. The midterm exam, as you can see here, will be available starting at midnight tonight, April 9th, and you have to take it by end of day Tuesday, April 14th. Okay? Now, don't actually click on the link until you're ready to take the exam, because when you click on the link, it's going to start a timer, and you have 4 hours to submit it. Now, I don't think it's going to take you 4 hours, but I'm giving you up to 4 hours. Basically, what the midterm exam is it's going to look a lot like your homework assignment, where you're going to download an Excel file and you're going to convert 4 tabs: TII, TFI, CFI, economic profit. You're then going to take that Excel file and you're going to upload it. And that's the exam. And you have 4 hours to do that on the honor code. At the end of 4 hours, it's not going to let you submit it. You're going to get a 0 on the exam. It's worth 10 points, no essay questions. That's the midterm. In the data file that you'll download, I'm giving you the 1, 2, 3, 4s. So you don't have to worry about that. So again, that's the midterm exam. You have essentially between tomorrow and Tuesday to take it. Okay. Now in the file section, just as a reminder, under week 3, I put a solution, an Excel-based solution to your conversion. So it's open book, open notes, open computer. Obviously you need a computer to do the exam. It's just individual, can't collaborate, and you can't use a solver or go like searching on the web for a solution file. But other than that, you're welcome to use this solution file that I'm giving you, as well as what's in the book to help you do the conversion. So that's the midterm exam update I wanted to give you. Update number 3. One of the teams switched their course project from Peloton to Costco. Peloton was going to have some problems. So in the files team projects folder, I put all their data to do the valuation for Costco. So tomorrow morning, I'm going to upload the rest of the data for your other teams so you can do the same valuation you did on Target for each of your companies. So I'll put the Bloomberg data files up there tomorrow. Okay, so you will have that. But what I also wanted to let you know is I put in a folder called sample presentations. So I do an undergrad version of this class. Turn that off. I do an undergrad version of this class, which has 160 students and it's 14 weeks long. And 2 semesters ago, they do a very similar presentation to your final presentation. These were 3 of the presentations that did well. They got A's. Okay, so as you work on the final presentation for week 7, you're going to have to give a 20-minute presentation. I just thought you might want to see like what does one of these look like that was pretty good. Okay, so I'll focus on, as an example, the Microsoft presentation. Jump to a different folder here. So when you do your 20-minute PowerPoint, you're going to cover all 4 sections. Now, again, the undergrads had 14 weeks to do this. You have 7. But basically, this was their agenda. This is the 4 sections: EIC, historical, multiples, valuation. And you can see how they kind of did this. They did their, buy, sell, hold opinion for Microsoft. They did their EIC analysis. They did their 5 forces. They did their historical walkthrough of the tree and the CFI. They had to do the multiple analysis, which is what you're going to be doing next week. And they had to do a valuation with an as is, a bull, a bear, and their rationale for each as they went through the models. Okay. So again, team did Microsoft, team did BMW, team did Under Armour. I put those 3 presentations online just so you get a sense of what you need to put together in 2 weeks. Now, I'd given you the requirements already online, but I just wanted to give you a sense of what would be a good presentation based on 3 teams that have previously done those. So I want to let you know that that was there. Questions about any of that? Hopefully pretty straightforward. Okay. And finally, I put up an announcement. So happens that I have 160 undergrads this semester, and I have 4 undergraduate TAs. These are the TAs. This is their contact information. This is when they hold office hours. Now that we've gone completely online, their office hours during these times are Zoom rooms. Okay, so if anybody is interested and you want to get some additional help on anything this semester, you're welcome to take advantage of these TAs and their Zoom office hours. These are the 2-hour time periods starting tomorrow and Friday. And these are the Zoom rooms that they'll be in during the 2 hours. I've let them know that I have approximately 39 online MBA students, and they are there to help you as well. I know they're undergrads, but they've been doing a lot of your content. They're good students. They were my TAs because they'd previously taken the class. They know the content. So if you want additional assistance with anything, feel free to take advantage of that in the next couple of weeks, starting tomorrow. Okay, so I made that available. All right. So today, what we want to focus on is the target valuation. You had to do an as is, a bull, a bear, and a target model for target, and a write-up explaining your assumptions along the way. Okay, so let's go over that file. All right. So doing what you did, I came up with an as-is valuation that was within 10 cents of the target price for target. It's hard to say target and target, of the actual stock price of target. And again, the standard was within $1. And so my guess is we should have some very similar information. So for example, on the assumptions, we all should have put in the same WACC, 5.7%. On the assumptions, we all should have put in the same shares outstanding. We're obviously working the same share price. We should have put in the same consensus estimates and multiples to get our EBITDA margins and our perpetuity margin, which means we should all have the same growth in EBITDA for the first 3 years. And the number for operating income and perpetuity should have been 6.1%. So we would have adjusted our EBITDA margin to 9.4 to make that 6.1. Okay. We would have looked up the tax rate. If you looked up the JP Morgan report that I gave you, you would have found in there that their tax rate was 23%. Now, a student in the last class said they actually went to the investor relations website and found some guidance for 22%, but 22, 23, any of those would be acceptable. It's not going to really change your answer too much. And my sense is that we probably wouldn't change the balance sheet because the productivity of 35% is pretty similar to what we had seen historically. So the point of the story is when you did the as is, it really came down to growth and G. Okay. Everybody get that? Similar numbers so far? All right. I'm going to pause here and pivot.
I have a question.
Yes.
Yeah. I went through the income statement and balance sheet, and I came out with the operating cash in percentage of revenue is 7% for target.
Operating cash, oh, you changed that to what percent? 7%?
Yes.
Okay.
Because I went through the data and I found that it's close to 7%.
Well, they might have cash that's 7%, but my sense is, and our model would do this, is a bunch of that cash we would consider excess versus operating. And so again, you can make an argument that they have more cash that's necessary to run the business they could never pay out. But generally 7% is basically saying that they have close to 3 weeks worth of cash. And so essentially what you're saying is that they actually no, 7% would be 1/12 of the year. Yeah, it's around, it's called, yeah. They have somewhere between 3 and 4 weeks worth of cash on hand. And that's probably a little much for what we call operating cash in the register. But I'm not saying you couldn't have done it that way, but probably wouldn't have put it that high. That's why we typically use 2%, 1, 2, 3% is typical based on what the book says. Book says use 2 as a starting point. But
Okay.
more. But let me just come back to, generally, no matter what you changed, you probably came down to what's the growth. So I want to pivot for a second, stop the share, and I'm going to create a whiteboard. Is everybody able to see this whiteboard? Okay. Now I'm going to use my poor drawing skills with my trackpad. Okay. So this, the graph, and on this axis, text, so I make the color darker. On this axis, we're going to have cash flow. And on this axis, we're going to have time. And if we think about a product life cycle, a company life cycle can look like a product life cycle as well, where it starts, goes into growth mode, becomes mature, eventually declines, and could eventually go away. Okay? And so companies can have life cycles just like products can have life cycles, right? And this is relevant to our valuation because where on the life cycle the company is going to matter when we do our cash flow valuation. And what's really going to matter is year 6 in our model, because we arbitrarily only did 5 years of year-by-year forecast, and we said year 6 represents the continuing value or perpetuity period. And what that you're going to realize is the vast majority of the value is going to be in that perpetuity. Now, the formula for a growing perpetuity is cash flow divided by R minus G. That's the formula for a growing perpetuity. Okay? Now, in the McKinsey version of key value drivers, we've rearranged that formula to create the key value driver formula of no plat times 1 minus G over ROIC divided by WACC minus G, right? But basically, the key value driver formula is just a growing perpetuity. The advantage of the McKinsey version is instead of forecasting cash flow, we forecast ROIC and no plat separately to get cash flow. But nonetheless, it's just a growing perpetuity. The reason that it matters is, let's say that year 6 for the company we're valuing is right here on its business life cycle. And we have to represent a G into perpetuity. So what we're going to do is our G is probably going to be something like this line, because what we have to represent is both the value up here during the continued growth and early maturity and the value of the decline. And we have to balance those two forever. So we're going to get a G somewhere in the middle. Okay. So that's why if the company's growing like 8% a year over here, right, we're still going to come up with a G of like 3%, because what we're going to say is, yeah, they're growing at 8, but eventually they're not going to be growing at all. So the average of the two is going to be probably closer to 2, 3, or 4. Okay. And so the point is, this is going to be your G. Okay. But if we value a company who's right here in their life cycle, well, what does our G line look like? It's going to look something like this. Because we have to forecast not only this period of small growth, but then eventually the decline in the life cycle, which means we can have a negative G. Because a couple of you emailed me and basically said, we can't get the valuation, the as-is valuation to work. There is no number that I can put in that makes the price get to that price. And I said to both the students, have you considered a negative G? And they didn't. It just didn't occur to them that G could go negative. Now, this is something that comes up as a common question, because the idea is when people think of a negative G, what they think of is, oh, this company's going to go away, they're going to go to bankruptcy. And what I want to represent is not necessarily. A negative G just means that the future is worse than the present. And a negative G of -1 or 2% just says, look, this company's peaked and the future is actually going to be worse than it is today. And that's what I'm representing by a negative G, as opposed to like -20%, which says you're heading for the ground and you're going to crash and burn. But the point of the story is you can actually have a negative G. And that was the case for Target.
I have a question.
Go ahead.
Okay, so and this is kind of going ahead a little bit, but I think you're going to be going over how to calculate G
We
pretty
are going to
soon,
cover that. Yes.
right? And so when you do that, you base that on the in this case, 2022's EAV over EBIT, right?
The second year,
Right,
yeah.
right. So you kind of you iterate and to figure out your growth. But if
Correct.
you do that, your growth rate based on that value is 3.65. So it's actually positive.
Well, let's
And
see, because when I did it, I got -2.1.
okay. Okay.
Let's come back and talk about that. But you're right. If we still get a positive number, we'd have to adjust it. But I just want to say, before we get to the formulas, I just want to make sure people understood conceptually how you could end up with a negative G. And it doesn't necessarily mean the company's going away. And it actually happens fairly frequently, not because a company's not going to grow in the long term, but what the market has done is it's kind of overshot the long term and has to kind of course correct to go more negative. Because here's the other thing that happens. Separate story. And again, excuse my poor drawing. Let's say you have a cyclical company. Looks like a sine wave. Has boom and bust cycles. And let's say that year 6 just arbitrarily happens to be right here at the boom cycle. So one of the things we're saying is, in our model, year 6 equals the future. Whatever they're doing in year 6, we're carrying into perpetuity. We don't change it. So if year 6 happens to be a peak and the company's cyclical, what's going to happen in the valuation is we're going to do this. We are going to overvalue the company because we're going to always assume the company's performance stays at that peak. It will never go down, and we will overshoot the value of the company. Conversely, if we value a company and year 6 arbitrarily just happens to be here at the bottom of a cycle, then what we're going to do is we're going to value the company as if it always stays poor performing, and we're never going to give it credit for improving, and we're going to undervalue the company. And I'm telling you, this happens all the time in the real world because people have trouble thinking long term. And that could be also one of the things that's happening with Target is right now the sky is falling. And in the world where the sky is falling, they can't see to themselves that Target could actually return to a growth stage in a few years because we can't see past our blinders of what's happening right in front of us. And so if Target really is in a valley right now, then the as-is valuation might actually represent a negative G, not because they're mature, but because the market can't see that they're actually going to recover. And they're just carrying this forward into the future, right? One of those two could be happening with Target, but it happens all the time, okay? And so that's what we have to be careful of, because ideally, when we get to perpetuity and we have a business that's having boom and bust cycles, where we actually want to put our valuation is right here. We want to put it in the midpoint, right? And so that's the whole point. Our model is just arbitrarily saying we're going to forecast 5 years, and then year 6 represents perpetuity, wherever it is. That's why I made those cells yellow, because ultimately, whatever that 6th year is going to have a big impact on the valuation. Now let me go back to our model. share my desktop. If I go back to the valuation tab, here's the other thing I want you to see, is this is our valuation. This is my as is of Costco. These are the cash flows for each of the first 5 years. This is the perpetuity value. They have a $61 billion value, almost no operating assets, 61 billion, 47.5 billion is perpetuity. So if I were to knock 10% off their margins in one of the years, I knock off $300 million in present value to the overall share price. It's not going to make a difference. The real difference is going to be made in this continuing value. And for better or for worse, the 80-20 rule of any company that you will value, this continuing value, is just these 4 numbers. They're everything to your valuation, right? As a matter of fact, we can probably agree that the WACC is not going to be too different amongst most analysts. Pretty standardized in Wall Street. We can probably say that the ROIC is probably not going to be too off across most of the models, right? So really, if I have a sense of how big they are, the G is going to be the most important factor. And that's why you saw, even in the valuation you did, slight changes in G had huge impacts on the stock price. So when it comes to coming up with the valuation, that G has the biggest impact on any company's stock price as to what people think that long-term growth is going to be. Okay, that is the key driver outside the spread that's going to really drive and be the fulcrum to any value, including target. So therefore, when we're doing the balancing between these 3 years and this G, the G matters more than those 3 years, right? And so the question is, you probably eyeball the G, and you could have come up with a couple of G's. Like I came up with -1% and 1%. But how do I know? How do I know it's -1%? How do I know it's not 0% or +1%? And then the growth in 2024 is like -5%, right? You could have probably gotten to the same share price by doing that, okay? So for example, if I had made the G here +1%, I could have come in here and I could have cut the growth to 5% negative or 10% negative or whatever, and I could have matched the share price, right? Now, how do I know that's probably not the right answer? One, I can't guarantee the future, but if you look at the analysts, most people aren't expecting Target to fall off a cliff in 2024. If they were to see a big drop in sales, it'd be in 2021 in the middle of the virus crisis. It wouldn't be in 3 years after recovering that most people think they're going to fall off a cliff. So conceptually, this wouldn't make sense to do -10%. I'd probably do the G. So the question is, how do I do the G? So here's the point. What he was referring to is next week. Next week is ratios week. And pulling ahead of one of the lecture notes that's going to be on the video when you go through the ratios next week. Pull out the lecture note for that. One of the things that's going to come up in the videos is this slide that we'll be talking about. And what you're going to realize is that all of these multiples, PE, enterprise value to sales, enterprise value to EBIT, etc., are just the rearranged key value driver equation. This is the key value driver equation. And if we rearrange it, we get the enterprise value to EBIT multiple. Okay? So one of the things about multiples of earnings, and this goes back to the multiples assignment you did earlier in the semester, is that those drivers not only explain the value, they explain the multiples. So here's what we're going to do. If this is the academic formula, and we believe the academic formulas work, we know the enterprise value to EBIT multiple in the real world. We know the answer because that's a data point right here for Target of 11.4. We know that number. And so the question is, working backwards, we have a pretty good idea what the tax rate's going to be. There's not a lot of ambiguity about what people think Target's tax rate is going to be in the future. There's not a lot of ambiguity about what the WACC is going to be in the future. There's not a lot of ambiguity of what their returns are likely to be in the future and their margins that drive those returns. So we can solve for a G. We can solve for a G that makes this equation work. Okay, so that's what I'm going to do. So I'm going to go back to the model, the as-is model. I'll go to my assumptions. Down here, what I'm going to do is I'm going to say, what is the forward year 2 enterprise value to EBIT multiple? And it's the same thing we did to get this estimated EBIT margin. And so again, content's coming next week, but we said it was 11.4. The 2 decimal places. Okay? That was just the observed number in the real world, 2022, second forward year. And part of the reason is this is the first full year of a clean year of forecast, meaning 2021 is dirty. There's some actual months and there's some forecast months in this forecast. This is the first full year that has 12 clean forecasted months. That's why we settle on FY2. Okay, so back to this, 11.4. We know the tax rate. So we're going to solve for a model EV to EBIT multiple. Spell. All right. That's going to be this formula. We're going to need a CVG, which is already what we're putting here. We're going to need a continuing value tax rate, which is the tax rate that we probably have here on our ratios. So we would have varying it year by year in H10. That's our forecasted tax rate. We're going to need a continuing value NOPLAT. Sorry, continuing value ROIC. And we're going to need a continuing value WACC. The continuing value ROIC was up here. And the continuing value WACC, we don't change in our models right there. So those are the 4 things that academically should solve for the EV to EBIT. So if I put in that formula with the correct order of operations, equals left paren 1 minus the tax rate, times left paren 1 minus the growth divided by the ROIC. And if I take all of that and divide by the WACC minus the G, that would be the enterprise value to EBIT multiple with 1% growth at that tax rate and that ROIC and that WACC. So here's the point. -1, 1234. -2, 1148. -2.1 match. So what I'm telling you is if I believe the academic formula is to be true, it's an assumption, then this reasonably, plus or minus a little bit of margin of error, has got to be the G that the market's using to get this share price. And so by the way, if I do that, I'm at 77 to get my as in the match. It's probably somewhere around 2.5 to 3% growth, which by the way, makes more sense because Target's probably not going to fall off a cliff in 2024. So when I'm thinking about G and I'm thinking about ROIC, the as-is valuation has less to do with the poor performance in these 3 out years and more to do about the concern with the long term, which, by the way, is the 80% of target's value. So it's the long-term growth, which suggests if I were to go back to my whiteboard, it's the growing perpetuity heading in a negative direction because target is peaked and people think that this is the best of times and the times going forward will be tougher. That's what the market's saying for the as-is. Now, you didn't do this for your target valuation. So if you had had a positive G and big negative growth rates in the 3 out years, I will accept that for grading for homework 5 as okay for your as-is, right? Because at least you got down to the negative growth. You're going to have negative growth somewhere. So whether it's a negative G or negative growth in the out years, I'll accept that if you got to within $1. But I'm saying realistically, it should have been a negative G and a slight positive growth rates of those 3 years that the market is actually expecting. And if we had thought about it intuitively, even without doing this, we would have probably had to come to a similar conclusion because having like negative 4 or 5% growth all of a sudden after growing at 4 in those out years, like that just logically wouldn't make sense if that dropped off the table. So we should have inferred that it was probably the G was negative rather than the out years. But as I said, I'm not going to hold that against you. But nonetheless, this is another way to do an as-is. Get more refined with the G. So once you get the G, you can back into the growth.
Professor, can I ask you a question about
Please,
maybe
I was about to say, so go ahead.
So, you know, looking at all that, it all makes sense. But I was curious, just going back to the EEO off of Bloomberg and just looking at, you know, the revenue forecast and what you had said about the number of analysts. So the column off to the side. And I noticed just looking at the year 21, 22, and 23, that there was only 6 analysts that went public, 5 analysts and 1 analyst. So could you make the assumption that because no one was coming public with their figures for a general consensus, that maybe the one guy that did was overestimating and, you know, you said that, well, maybe my revenue and thereby like my the EBIT that I took off of there, giving me the margin was a little too high at 6.1.
So given the process, I would prefer it if you did this. However, given the real world nature of Target, what's probably explaining this is most analysts have no idea what Target's revenue is even going to be this year. We just don't. We don't know. I mean, I can't go to Target on a regular basis and shop. I'm supposed to be sheltering in place. So the fact that, you know, e-commerce is tough, you can't order stuff online. Even Amazon's now pushing stuff out 30 days. So nobody knows what the revenue is going to be of these companies. So it's not surprising that the analysts are starting to pull their revenue targets because they're kind of afraid to figure it out. But the flip side is somebody's still got to come up with a DCF that justifies a $93 price because they're trading at this today. So we got to come up with a price. So here's the point. You could have made an argument in your as-is. I can't say it was wrong that you could have overridden what I told you to do and made these go negative. And I can't say you're wrong because even the analysts are up there. There's only 6 of them. There's a bunch of analysts that aren't. And some of them could actually have negative growth for Target this year. Same thing, that these margins could be worse than what 6 of the analysts are projecting. I can't say you're 100% wrong. Now, that's not the preferred process I would have had you do. But as long as you can justify it, I'll consider that because here's the point. There should be a rationale for doing it. All right. I don't want you to just do this because you're plugging and chugging. All right. I want you to be thinking as you're putting these numbers, like, does this make sense to me? And that goes back to the analysis that you're doing in your write-up. Like if you say that the margins are going to be lower, there should be a rationale for that as opposed to, well, that's just what makes the math work. Okay. And that's basically what I need to get us past. Because anybody can just throw a bunch of numbers in and solve an equation, but that's not the goal of what we're trying to get to here. We're trying to understand why we're putting the numbers in that we're putting in. So, long answer to your short question. Other questions, comments about anything?
Just a comment. This is Nate.
Yep.
I think it makes a lot of sense now. I didn't consider that I could do a negative G
And by the way,
So
most people, there's a lot of people that don't. They never even think about it that way. So don't feel bad. So keep going.
so I kind of struggled, and like you said, changing all the numbers. I thought about making some changes on year 21, just based on what is going on now, but it was still kind of different. So what I did was I kind of played with the operating cash flow, operating cash as a percentage of the revenue, and lowered my G as much as possible. And then, did change some numbers. Some I couldn't remember exactly to kind of get too close to it. But I think this was pretty much very challenging of all that I kind of did this week.
That's why I give you these assignments, because I don't want to just make everything cookie cutter. I could have given everybody Costco and we just phoned it in. But here's the point. So two comments I want to make is, number one, every now and then, and I didn't do it this time, but every now and then, you're going to get something that you just cannot explain. Like, there is no amount of logic that's going to explain some share prices. That's just the real world. Some stuff is just messy. Now, I don't think that was the case with Target, but you could run into that situation, right? But that's the second piece, is that there's a fine line between sort of crazy and wild. And what I mean by that is, you got to start almost questioning yourself. Like, when I have to make crazy changes to my model, like, am I doing things that are just plugging to chug, or is this realistic? Because at some points, like, yeah, you could change operating cash to 20% and kill the share price. But is that realistic for how you think people are thinking about Target? Probably not. And by the way, don't assume that WACC is sacrosanct. Meaning, if I were to value Ford right now, and I think we talked about this in the Outline MBA. If we looked at Ford's WACC, it's like 2%. And there's no way I would use a 2% WACC if I were valuing Ford. They're too damn risky, right? So why would I accept 2% return long-term for Ford if I were a hedge fund or if I were a money manager? No matter what Bloomberg said, there's no way I'm using 2% to value Ford. So realistically, you would override the Bloomberg WACC, because yes, Bloomberg can mathematically calculate a WACC because they're so over-levered at the low cost of debt right now that the credit rating doesn't reflect their true cost of debt. But the flip side is, no one in their right mind would buy their share count at that level of WACC, and the institutions would put in their own number for the longer term. So as I said, sometimes we'd have to figure out that we could put the numbers in, they don't make sense, right? It just so happens that I can actually make sense of the story I'm telling you for Target, right? For reasons that I showed you on the whiteboard. But regardless, these are some of the things we have to consider when we start putting the numbers in. Right? So it's not just as simple as a plug and chug exercise. Any other questions or comments before we talk about the bull and the bear?
So another question that I had was in regard, so you modified the G, but another option would be to modify the ROIC, because in that equation, right? And so if you play around with that, then that's like, you could almost play around with both of those, G and ROIC, to a certain extent, correct?
Yeah, because, and what you'd be doing implicitly is, if you're playing around with this ROIC, what you're basically saying is, I don't believe that this EBITDA margin is going to be the same in the out years. Because if you think that the perpetuity EBITDA margin's lower, by definition, their ROIC will be calculated lower. So you could have left this alone and then played with the ROIC directly, or you could have gotten to a lower ROIC by changing that number, right? But if you believe that this is not representative of the long term, because that's the point. If I'm having the waves and I say, well, no, this is really a peak, and they're going to start going down beyond year 6, then I could play with the ROIC and say my continuing value is lower because year 6 is not representative of the longer term. So I'm going to override that and give something more representative of the longer term. Absolutely, you could do something like that.
Right, and I think one thing to consider is, you could still have positive growth. And going back to KVD, if you have a negative spread, ROIC to WACC, and you're growing, you're actually hurting your EV.
Absolutely. By the way, so there's 2 other scenarios that can pop up. It didn't pop up for Target. And unfortunately, we don't have enough time to give multiple scenarios over the next 2 weeks. But I'll tell you 2 other things I've seen. So number one, you get a company with close to 0 spread. Guess what happens when you get a zero spread to your G? Remember that assignment? What happens when you have a zero spread and the G changes?
Nothing. You can't change your valuation.
Exactly. So the point is, you can put whatever the hell G you want, and nothing's going to happen to the company because the spread is zero. And then you have a company that has, for example, a high share price, and you're like, how could they possibly have a high share price? Because I can make my G infinite, and the share price isn't moving. So what you have to start to realize is, hey, the spread is not the right spread. That the perpetuity spread has to be different because that's the only way you can justify the high share price. So you actually do have to modify the ROIC because the G won't actually be a driver, right? And then there's the Under Armour situation. After Under Armour effed up, they went off a cliff. And if you actually look at their multiples, which we might next week, at the time, this is last year, you couldn't explain the multiples with their current spread. And this is the comment that I would make about the airlines. Those, I don't know if I said this to your class or the last class, but I got a couple of people asking me, is now a good time to buy airlines? And I'm not going to make a professional recommendation, but let me just ask the group a question. Do you think we're going to go back to normalized air travel in 3 years? In 3 years. Do you think we'll be traveling like we used to in 3 years? Because if the answer to that question is yes, then now's a good time to buy the strong airlines. Buy Delta, buy Southwest, buy United, because they're probably not going away. And when the market returns to normal, they're probably going to be okay. Could they have a rocky road to get there? Absolutely, but they're probably going to make it. So here's the point. Under Armour was the same issue. Under Armour had horrible performance because they were doing accounting fraud and they couldn't sell anything. And the market freaked out and oversold them. And they had a negative spread, but they didn't oversell them that much. And the negative spread didn't explain their share price because the market said, you know what, Under Armour's going to get past the accounting fraud and people still are going to buy their product and the sports teams still like their brand and they're going to return to some level of normalcy. So they were priced as if. They weren't priced based on the modeling stuff. They were actually priced as if people thought that there'd be a return to normalcy at Under Armour. I'm not saying the market was right or wrong, but sometimes you can't explain what you see because they had a negative spread, but they were priced as if they had a positive spread. And that was just what the market was saying. They thought that they'd eventually turn to the positive spread. And it was just not easy to model. So again, I say this because there's always exceptions here. And what I really want you to do more than anything else is understand A, a process, and B, understand why you're doing what you're doing as you think through the process. Because there's a little bit of an art to this. But if nothing else, I'm giving you the process to start with. And as you ask these questions, are the right questions to be asked, because it helps you kind of poke holes in your model and think it through, right? But the whole point of the as I remind ourselves of what we're doing here, is we're trying to say, assuming that the academic formulas work, and assuming that we have some reasonable endpoints, let's back into the data that makes it all work, okay? And it's not whether we agree with it, but this is a baseline to understanding a company, because your opinion will show up at your target. That's the whole point of the target model. The target model is the time for your opinion. This is not your opinion. This is reasonably trying to solve with data and the academic models. And this is a process most people skip. Very few people in the world have even heard of the concept of an as-is. Students that I taught do this in the real world because they start to see the value. Because if nothing else, it gives me a baseline. I don't have to agree with the baseline, but at least I have some baseline to understand what's going on in the company before I start making my own crazy assumptions about what's going to happen in the future. And I find that to be a useful part of the process. So with that in mind, let's talk about the bull and the bear. Somebody want to talk about their bull and bear? Because we got a target share price of about 93, 92.57 was the price last week. What's the bull? What's the bear? Who wants to share their thoughts? And preferably your Excel file, because I'm going to hit stop share. And the beauty is we can all hit the share button at the bottom and share our own desktops. Good practice for 2 weeks from now when you're doing your PowerPoint presentations. And share me your bull and bear. Anybody want to volunteer?
I'll volunteer.
Great. So just bring up your bull first or your bear first, one of the two, doesn't matter. And just kind of walk us through what you changed and give us your commentary just overall about why you changed it. See what you thought.
Just opening everything up. 1 sec.
And as I said, you can you should be able to hit the share button at the bottom of the Zoom window and then just share your desktop or share the Excel file.
Okay, everybody see my screen?
Yes.
Great. So this is my bull file first.
Okay.
So trying to retrace my steps because I actually thought I was opening the bear. So a couple of things that I
So
thought.
this says bear. It says bear across the top.
It says bear. Oh, okay. So I did share it, but I had it on the opposite screen. Okay. There we go. All right. So with my bear scenario, there was a couple of things. So the first thing that I looked at was with the assumptions, the negative G that we had, I actually reverted back to a rate that I thought was more in line with current 10-year treasury. So I moved it to 1%. I think that the current situation being affected by coronavirus is actually forcing us into this situation where we have to kind of use a negative G, where there's so much uncertainty in the current environment that it's hard to really value companies, and that's part of the reason why we're seeing this negative long-term growth rate. I don't actually think that Target is on the downtrend in their cycle.
Well, like I said, that'll be what your target price is, but this is just kind of the more pessimistic scenario. So we're just establishing.
Correct. And my target price, I guess I should have started there, although I kind of worked in my writing to that. My target price is 84.84 in this current model.
That's okay. Now this is for the bear or this is for your target?
This is for the bear.
Right.
I should say that the model price within the bear.
Yeah.
Yeah.
So what you're telling me is you think in a negative scenario, Target has a floor of around $84, $85 a share. That's my downside risk. I have about, call it less than 10% downside if I were to buy Target today.
Correct.
If all these things.
Right. And the first thing that we're talking about is, I think that this short-term, what's the word that I'm looking to, shock to the world economy and the U.S. economy is going to have a less than 1 year, probably just a few quarter impact on Target's overall business model. Even in the bear case, I think that we see normalized long-term growth. So that was the first point.
So
or more normalized.
Can you put up the bull?
Oh, you said go to the bull?
Can you go to your bull?
Yeah. I have just the Excel file shared. Hold on. How do I stop share? So.
And just go to your ratios tab. All right. Wow. 191 on the bull side. All right. So what?
So
we're running with the bulls here.
Yeah. So just to touch on, because it goes into my target. I also, in the bear situation, increased the tax rate with the assumption that we see a change in the political landscape and taxes revert back to more Obama era levels. So I put it like at 33, I think, from 22 fiscal year on. So to the bull, basically, I think that there's going to be a lot of pent up demand from the coronavirus shock. And then you're going to see a lot of people do all the purchasing that they've kind of stopped. You've seen apparel kind of in Target stores from the JP Morgan article. They talked about how hard apparel was hit, that kind of stuff. So I think that kind of reverts itself when we see levels back when they were even, and obviously with the bull case, you're even thinking potentially better levels than what they had in 2019. So that's where I got the 4% revenue growth. I went to a more commonly used, I would say, long-term growth rate based on historical 10-year treasury rates. And then I also, in this, assumed that they had slightly increased margins, like they maybe shifted to a slightly higher higher margin products in their store that they were selling. So a slight increase, basically more in line with some of their historical abilities, and that
Let
all
me
led to the higher
let me give
share price.
my quick interpretation. See if anybody else has any other comments to add. But two observations. Number one, you're valuing Target, not Target, and you're basically saying, given their current share price, there's approximate 10% downside risk and 100% upside in the next 12 months. So you don't have to tell me that your target share price is a buy.
Right.
So you're probably not at the 100% range, but I'd be willing to bet money that you're on the buy side. And
Yes. So
target is near the floor today, and they got a lot more upside than downside.
right. So if we move now to,
You can just tell us what the target is.
yeah, the target was 122.87. So more reasonable. Again, I think growth rate at least returns back to 2019 levels. I didn't assume quite as high of a G. I assumed a 2G, but I did assume some of the bear case scenarios. I do think that there is political risk where tax rates, corporate tax rates could increase. So I factored that in. So it's kind of a mix of the two, bull and bear, to get to the 122.
Okay, as I said, that's your opinion. And again, you're $9.30 higher than the current share price, which puts you into the buy range. That would be a
Or
buy.
$30, 122
more
versus
than $9.30.
Yeah.
Therefore, you're in the buy range. Anything above $9 would have been a buy. So you're in
Gotcha.
the buys.
Yeah,
Okay.
more than 10%. Gotcha. Yeah.
Does everybody agree with what he said? Does anybody have a different range?
I would hope not. I mean, I would hope not that everybody agrees. I hope everybody has slightly different opinions, because
Well, that's the point. There's no right
it's
answer.
all, yeah.
What are some of the other opinions on target? Somebody else have a different perspective?
I guess in terms of the competition, if you consider,
give me your bull and a bear. You don't have to share your screen, but just give me your bull and your bear price.
so my bull is 144.65.
Okay.
My bear, is 75.28.
So let's just start with that. Your range is less upside than what Eric said and more downside.
Right.
So what do you see that had more downside that he didn't, just out of curiosity?
Just in terms of the revenue growth rate, I think
you made that really caused it to go down much more. What was really pushing the negative share price drop?
probably the G.
What G did you use?
So the bear, I use -2%.
And what'd you use in the 3 out years?
-2%.
What'd you use
I
in
kept
the
that
full range?
Full range was +2% in the 3 out years, and I kept that consistent for the perpetual growth rate.
All right. So just to summarize, another insight you shall be getting is, plus or minus 1% growth, plus or minus 1% margin, therefore driving ROIC. It's going to have a huge impact on target share price. Okay. So target is very sensitive to changes in margin. Target's very sensitive to changes in growth as it comes to leveraging their share price. And so, that's the point. Plus 2, minus 2, that's a $100 difference in share price right there in your model. And where you are in that range is going to be your view of what happens to the margins in the future, and what you view of that environment. It's probably going to jade whether you think you're more on the buy side or the hold side or the sell side. Where'd you end up with your target price for target? Approximately. Were you in the hold range?
I was actually more bearish.
Were you more than $9 below their current share price for your target?
I think I'm trying to remember. I don't have the target up here.
Because you're either at the bottom of the hold range or you're a sell. And that's actually important, is plus or minus 10%. When you guys are giving your presentations, I want you to be very specific. Use that range. So if target was trading at 92 something, then anything below 83 should be in the sell range.
Okay, yeah, I was at 80.
So that's a sell.
Yeah.
Okay, so that's interesting. You have a very different opinion than the previous student. And I'm not saying either one of you are right or wrong. What's going to be important to me, not only for grading, but even when you're doing your group projects, is understand your point of view. What did you change? Why did you change it? And do I believe that? Because that's just as important as making sure we get the math right when you do your presentations. Okay, and hopefully it's been that you're not just pulling it out of your butt. You actually read some things that led you to draw those conclusions or had some experiences. Okay? Which I heard from both of you, but that's what we want to do in the buy sell holds. Okay, so we had a buy, we had a sell, no different than what we see on Wall Street. And that's the point. It's hard to predict the future. But what's important, if you're going to actually explain this, is get the model right, make sure you're articulating reasonable assumptions, back it up with some sort of substance, and help people understand what could change and why it would change, right? Because that's a better model than just somebody giving me a target share price. And that was what we practice here for target. All right, questions about anything you did this week? All right, so again, 2 weeks from today, you will be taking for one of your group project companies, same process, and you'll be having 20 minutes for your presentation. So as part of that 20-minute presentation, sharing my desktop here. As I said, I gave you examples of, in here, files of some sample presentations that represented the 20 minutes. Okay, so you think about approximately 5 minutes per section, 5 minutes in EIC, 5 minutes on historical, 5 minutes approximately on the valuation, and then 5 minutes on what we'll be talking about next week on multiples. Okay. In terms of content for tonight, that's all we were going to cover. Make sure you complete the midterm by Tuesday. Please start working in your groups to start pulling this together. You don't want to be doing it at the last minute. And as I said, if you're having questions about anything, you want some specific one-on-one time, take advantage of my 4 TAs office hours over the next 2 days and their Zoom rooms if you want some one-on-one time with any of them. Okay. Any last comments before we close up tonight? Okay, I'm going to give everybody a little time back. Stay safe, and we'll see everybody next Wednesday. Have a good night.
Thank you.
All right, bye-bye.